Well, it's not really easy to do, but there are ways to get a mortgage with very poor credit. If you want to know more, I want you to stick around till the end of today's conversation. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or a tea or vodka and let's roll. In today's conversation, I want to speak to you about a method that will help you, a step-by-step that will help you get a mortgage with very poor credit. Contrary to popular belief, you may still be able to get a mortgage even if your credit is less than stellar. And borrowers with bad credit can often get mortgage financing through programs tailored specifically for them. Equally important, credit scores are not permanent, right? So with a few financial adjustments, you may be able to improve your score and move into a better credit range, which can mean lower borrowing cost when you do close on your loan. So when we speak about credit scores, what do we talk about? We talk about 5 different layers, if you will, 5 tiers of credit. You have exceptional, so your FICO must be between 800 and 850. Very good, 740 to 799. Good, 670 to 739. Fair, 580 to 669. And very poor credit, 300 to 579. 300 to 579. So in today's conversation, I'm focusing on those folks who are in the 300 to 579 category. And even borrowers in the fair and very poor tiers may be able to qualify for mortgage financing. And for example, you have the Federal Housing Administration has FHA loan, the so-called FHA loans, the home loan programs designed for borrowers with credit scores as low as 580. So when we speak about credit scores, there are some credit scores that are too low to qualify for a mortgage. For example, anything below 450, 460 is really too low. So you want to really, if you are in that band, in that tier, you first want to work on your credit score to improve it before looking for a mortgage. And lenders actually, besides credit scores, lenders pay attention to 2 other things when they evaluate a bad credit borrower's application. For example, you have loan to value, the LTV, and they also check something called the DTI, the debt to income ratio. All right. And one thing I want to say here is that it is very important to understand that you're going to have to pay extra if you have a low credit score. And I'm showing you right now on the screen a table that kind of recaps the additional money that you might be compelled to pay if you are in the very poor or poor category in terms of credit worthiness. So you can see it, FICO score, the APR, the monthly payments, and the total interest paid. And this is courtesy of myfico.com. Now let's get into the nitty-gritty. Let's get into the step-by-step. How do you get a mortgage with very poor credit? Number 1, I want you to check your credit report to make sure it is correct. By law, every year, you are entitled to a free version of your credit history or your credit report. And you need to go to a website called annualcreditreport.com, and you are entitled to, and you can get a free copy of your credit report from each of the 3 reporting bureaus, Experian, Equifax, and TransUnion. Okay, and once you have the report, you want to check for errors. Very important. And what are some of the common credit report errors? You have inaccurate account information, incorrect personal details, and fraudulent accounts. Yes, folks, identity theft is a real problem. This is very important. And you also want to make sure that you are able to have a credit report review checklist. So you can have identified information, creditor information, collection accounts, public records, inquiry sections. And the whole idea here is to go through your to really comb through your credit report to make sure everything is accurate. Because think about it, we're talking here about thousands of dollars that you might have to pay additionally if you have a low credit score over several years. So spending 30 minutes or 1 hour or 2 hours just to comb through your credit report is definitely worth it. And so once you actually discover some errors, you have ways to actually dispute them and get them removed from your credit report. Make sure it's a legitimate error. You want to send a letter to the bureau that reported an error. You need to remain patient, and you need to determine whether the resolution is adequate. If not, you can redispute the error. You can report the credit reporting agency. You can go directly to your creditor, or you can compose something called a statement of dispute. All right, and then you repeat everything, and then you follow up. The whole idea is just to be persistent. You want to be perseverant and you want to be persistent, but also be patient. Step number 2. If you're trying to get a mortgage with the very poor credit, you might want to consider a rapid rescore. What is that? Credit report changes can take time to go through the system. That means improved scores might not show up in time for a mortgage application. So in this case, you might want to get a so-called rapid rescore through your lender. So a rapid rescore allows a mortgage lender to submit proof to a credit agency that an applicant has made recent changes or updates to their account that have not yet been reflected on their credit report. And borrowers actually can request their own rapid rescore. The service is offered only to lenders, so the borrowers cannot request that. So a rapid rescore is not free either, but the fee for adjusting your credit during your mortgage application could be offset by your lower interest rate. So this is very important. And how much does it cost? In terms of dollars and cents, the fee for this service runs between $20 and $100. Okay, this is something that you have to, but the one thing that you also need to think about is that even if I said earlier that the service is only available to lenders, it doesn't mean the lender will have to pay the bill, because the Fair Credit Reporting Act prohibits lenders from charging a fee to dispute or correct credit reports. This is why not all lenders use the service, and you may have to request it yourself. So before you feel sorry for the lender paying the bill, this does not mean it will not still make plenty of money on your loan somewhere else in the process, probably in your closing cost. Keep in mind though, that if by using the service you're able to bring your score down enough to put in a lower interest rate, that's pretty cool, because the money will be well spent. This is an investment, because every percentage point makes a difference and can reach into the thousands of dollars over the life of a mortgage loan. And one thing I also want to say here is that bearing a surprise, like you forgot that you just charged the down payments for a new car on your credit card, taking advantage of a rapid rescore will almost certainly raise your credit score. This can in turn make it easier for you to be approved with better terms. Okay, credit scores, we all know it, are not the only factor in mortgage approvals. Current rates, property location and price, type of loan, and the amount of your down payments are among the other factors, but your score certainly matters. So think about this. Step number 2, consider a rapid rescore. Step number 1, check your credit report to make sure it is accurate. Step number 3, try boosting your credit score. This is totally different from a rescore though. A rapid rescore is totally different from boosting your credit score. All right, those are different processes, if you will. And there are 3 ways you can increase your credit score fast. You have the DIY option. In other words, if you want to increase your credit score personally, you can increase your available credit. You can pay for deletions, and you can stay away from hard credit inquiries. What does that mean? While getting an insurance quote will not affect your credit score, applying for any type of a new credit will. Those are the hard pulls, right? So having too many inquiries on your credit is not a good thing. Lenders see this as a sign of desperation that you need more credit. Plus, it also lowers your score. You should always ask a lender if they are doing a hard pull or a soft pull on your credit to make sure you protect your score. Also, think about paying for deletions. One of the worst items you can have on your credit report is a collection. So collections Show lenders that you owe money to someone and that you have not attempted to pay the money back. Even if you pay the collection off, it can remain on your report as paid, which is better than having an outstanding collection, right? However, the best result, which will help your credit even more, is to request the items be deleted from your credit report if you make the payment. Before making a payment for deletions, make sure you get the transaction in writing. It will basically be like you never received that collection in the first place, and this will increase your credit score and give lenders one less reason to decline you. And how to increase your score gradually. So first, I explained to you how you can increase your score fast, right? By increasing your available credit, by paying for deletion, and staying away from hard credit inquiries. Now, how do you actually increase your credit score gradually? There are a few things you can do. Now, you need to understand that your credit score is made up of 5 things, right? Your payment history, 35%, your credit utilization, 30%, the age of the credit history, 15%, the credit mix, types of credit, 10%, and the amount of new credit, 10%. So once you know the components of the credit score, it's really up to you to actually craft the best strategy to increase your credit score gradually. Maybe you might want to keep making payments on time consistently. You might want to reduce your credit utilization ratio, your CUR, and you can do that by, among other things, by increasing your available credit. And you also have the age of the credit history. So this is just a matter of time. This is a time factor. You just have to wait. But the bottom line here is that you can actually boost your credit score either fast or gradually. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We are also having a conversation today about how to get a mortgage with very poor credit. Step number 1, check your credit report to make sure it is accurate. Number 2, consider a rapid rescore. Number 3, try boosting your credit score. Number 4, create a budget, save, and start a mortgage fund. Very important. What is that? First, budget. To improve your credit standing, you must know that you are spending to avoid racking up debt. You really must know what you're spending on. The best way to do this is with a budget that tracks income and expenses. So you want to look for opportunities for small savings because guess what? They add up. You also need to save. Although you're looking to get a mortgage, you must have money available for emergencies too. You never know, right? You want to set aside cash every week or pay period and aim for at least $400 in savings to start. You must have savings to buy a home as well, not only for a down payment, but also for closing costs. So you got to really get yourself into the habit of saving regularly so that you can actually be ready when you're hunting for a house, or you actually when an emergency strikes. And a lot of experts are telling you they will tell you to have to save the equivalent of 6 months or 9 months worth of living expenses. I think I'm more conservative, so I would suggest you go for 1 year or 18 months. You also need to think about making all payments on time and in full. This is a gold standard for good credit. You want to develop the habit of making bill payments on time because this will allow you to avoid late fees and other needless costs, as well as blemishes on your credit report. And as you actually as you are creating a budget, saving, you want to think about starting what we call here at the Awesome Sweetie Kiwi Show a mortgage fund. And this would allow you to actually make a larger down payment. It is possible to have both bad credit and substantial savings. Lenders are often willing to accept a borrower with bad credit in exchange for a larger down payment. So if you want to get a mortgage, a car loan, or just about any other form of financing, the time to improve your credit is before you apply. It can take weeks or longer to resolve credit report issues, and you want to get them straightened out ahead of time so you can get the best possible rate on your loan. And so you want to give yourself at least 90 to 120 days if this is your goal, in terms of creating a budget, in terms of saving, and in terms of starting a mortgage fund. Step number 5, folks. I want you to shop around. Very important. Some lenders offer better financing terms than others. You may be able to save thousands of dollars by merely checking out various lenders and locking in a lower rate or paying less in fees. So you want to check for all types of bad credit home loans available in your area. Look for programs widely used by first-time and low credit buyers, such as FHA mortgages, as little as 3.5% down. You have VA financing, 0 down. You have USDA mortgages, 0 down. You have Fannie Mae Home Ready mortgages, 3% down. And the Freddie Mac Home Possible Loan, 3% down. You also want to look at a variety of lenders. So you want to look at traditional brick and mortar banks. They're not the only mortgage game in town, right? But you also want to look at other non-bank lenders, online banks, credit unions, community banks, mortgage bankers, mortgage brokers. You also want to look at alternative lenders, peer-to-peer lenders, P2P lenders. All of those players want your business. So you want to let them compete for it and see where you get the best offer. Let me just elaborate a little bit here. So you have home loan options for buyers with bad credit. The two primary types of home mortgage loans are going to be loans backed by the government and conventional loans. So the difference between the two is that a conventional loan is not backed by or insured by the federal government, but government-backed loans are. So you will find that a loan backed by the government will have lower requirements for your down payments, your credit, and your debt-to-income ratio, your DTI. And these loans are also less risky for lenders. So you have the FHA loan, right? This is a loan that is backed by the Federal Housing Administration. And if you are a first-time home buyer or haven't purchased a home in the last 3 years, you could qualify for this loan. And then you have the VA loan. If you are a veteran or an active duty member of the armed forces, you could qualify for a VA loan. And this loan is backed by the Department of Veterans Affairs and allows any qualifying service member and their qualified spouse to buy a home with 0 down. You have a USDA loan. This is another loan that is backed by the government department. This is the U.S. Department of Agriculture. And a loan from the USDA allows you to buy a home in a qualifying rural area with a $0 down payment. And what I want to say here is that you also want to look for the best home loan options for buyers with bad credit. If you type this online, you will find a constellation of loan options out there. And the best home loan options for you are kind of cool, especially if you have bad credit. And the thing we've seen in our research is that it all depends on how bad your score is. Because when we talk about very poor credit, are we speaking about 300? Are we speaking 400? Are we speaking 450? Are we speaking 500? Are we speaking 525? Because all those numbers are within the band that experts call bad credit. Step number 6, folks, I want you to seek help. If you're looking to get a mortgage with very poor credit, seek help. There's nothing bad with that, right? Find a co-signer. If you have very poor credit, you might consider asking a friend or a family member with better credit to co-sign your mortgage. The co-signer's credit will give your application a boost, but the co-signer will then be responsible for repayment of the entire debt, not just the part if you default. Also, if payments are late or missed, the co-signer's credit will be damaged. So what you want to do is you really want to explain that to the prospective co-signer and make sure that he or she is fully aware of the consequences of their signature. If they actually put their signature on the loan, it carries consequences. It carries legal consequences. Another way to seek help is to see if you qualify for down payment assistance. There are more than 2,500 down payment assistance programs nationwide to offset down payment costs via grants and credits. You can search by locations. There is a nice website called downpaymentresource.com. You can search by location there. And you also want to look for first-time home buyer programs. And you may qualify for those programs even if you have owned property before. In most cases, what the government calls a first-time buyer is just someone who has not owned a property in the past 3 years. And I want you also to be cautious with new credit. If you're trying to get a mortgage with very poor credit, you have to be strategic with new credit. Be careful about closing credit cards. A closed credit card can lower your credit score. The reason? Closing a card means your available credit has dropped. reducing your borrowing power, and more importantly, your CUR, your credit utilization ratio, which is a measure of how much credit you have used relative to your total credit availability. And don't open a new credit card, or make a big purchase, because a new credit account or big purchase can push down your credit score. So avoid taking on or applying for new debt during the mortgage application process. You want to wait to take out any new loans until after you close. This is just being strategic, right? Being mindful of how those any actions that you make during the mortgage closing process, whatever actions you make, has an impact on your eligibility prospects, if you will. All right, folks. Thank you very much for your attention. I really appreciate it. I hope that now you have a better understanding of how to buy a house with very poor credit. There are several options available, and your specific situation will determine which option is best for you. With a loan backed by the government, like an FHA loan and a pretty strong down payments, you can qualify for a loan even with a 500 or 400 credit score. And for a loan with a 500 credit score, you might need a 10% or 5% down payments. While it's also possible to get a mortgage with bad credit, you will probably be dealing with a much higher interest rate and a higher mortgage payment set of mortgage payments, if you will. So it might be tempting to buy a home today, but it's best to take the time to improve your credit score first before you start shopping for a loan, so you can get access to more lenders and lower interest rates. So just kind of recap here. In today's conversation, I spoke to you about how to get a mortgage with very poor credit, and spoken to you about 7 steps. Number 1, you want to check your credit report to make sure it is accurate. Number 2, you want to consider a rapid rate score. Number 3, try boosting your credit score. Number 4, you want to create a budget, save, and start a mortgage fund. Number 5, you want to shop around. Number 6, you want to seek help. Number 7, you want to be cautious with new credit. Thank you so much for your attention. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.